So you are a GEPF member and you are thinking of resigning from GEPF. But one of the things that's concerning you is your income. Is your income going to fluctuate? You worry that if the markets had to perform well, your income's going to be secure. But what happens if the markets dip? And what if you get an income that's too little? How do you manage with your expenses on a month-to-month basis? Now, in this particular video, I'm guiding you on everything that you need to know in terms of your resignation income options and covering this myth about the income fluctuating. I'm Devanaika, and I help government employees live the best life possible with the money they have. And let's get started with today's video. The first thing that I want to share with you is, let's start off with the process from the beginning, right? Meaning how the money actually transitions. And then I want you to have an understanding as to which portion of the money we're actually referring to. Now, you know that you've got some capital that sits here within GEPF, and there's actually two routes that you could take, right? The first route is you could opt for this money to be taken out in cash. If you do that, this is where you're going to pay a significant amount in tax. Now, if you're going to be moving to the second route, where you want to save the tax, then you are moving to an approved fund. Now, a reminder here, there's very commonly members tell me that the preservation fund is where they want to move to. Please remember, the preservation fund is one of the options that's available as an approved fund. You want to make sure that you consider all the options carefully, because once you make that decision, you cannot go back and change it. So your first step is most likely moving over to the approved fund, because that's how you save the tax. Then you know that from the approved fund, you can take up to 1/3 in cash. This is your cash benefit. And then I'm going to be talking to you about the pool that this video is all about, right? Which is the income from here. So 2/3 capital is what you're going to invest. And that capital is what then provides you with an income. So this video is all about this 2/3 portion. And the main concern that you're having now is that income going to fluctuate, right? Because you know, if you had opted to retire, there's a set income that is available. Now, the concern is this income that you're getting on resignation going to fluctuate? To understand this better, we've got to look at the different options that an insurance company provides us, or it's going to provide you in the event of you opting on resigning. And this is again applicable to the 2/3 portion. Now, to make the math look easy for this video, I'm going to be working with a figure. Again, you can use your figure as you go along, right? So in my example, I'm going to make an assumption that the amount of money that you have sitting within GEPF is going to be 6 million Rand, right? So 6 million. This is just to make my math look easy, which means the portion that is taken out in cash here, this is 2 million, and the portion that's available for investing is now 4 million. So when I'm working the figures for you, I'm working on a 4 million Rand amount, right? But you can do this calculation again based on your exact figures, right? This is just again to make the math look easy. So the first option that an insurance company provides you, this is option 1, is they'll provide you with an income for life, right? So it's an income for life. What this means is you're never going to run out of an income, right? It's going to be provided to you for as long as you live. If you live to 80, you're collecting it to 80. If you live to 100, you're collecting it to 100. If you live to 150, you're getting it to 150. You're not running out of money, right? Now, in terms of the income itself, is the income going to fluctuate? So in advance, when you're setting up this structure, certain things can be put in place, meaning you can choose the annual increase, right? And that annual increase could be based on a number of factors, right? You could choose it as a percentage, meaning a fixed percentage, maybe 5% or 10%, you can adjust that. You can choose it based on inflation. So the key thing is you are choosing that setup in the beginning, right? And once you choose that setup, it's going to run like that all the time, meaning it doesn't require any management. It's going to constantly operate like that. Let's use an example. If you had chosen an increase of 5%, that means every single year, your income will increase at 5%, right? You don't have to be concerned about the markets for this particular option because it's just going to keep increasing. The second route that is here is where you take an income for life, which is option 1, and now you are including your spouse. Now, here's the concern that most members have about option 1 that I've explained to you now, right? What happens if you pass away? So if you pass away in a short space of time or at any time that you pass away, that capital stays with the insurance company, right? Nothing goes on to your family or even to yourself, right? Like into your estate. Nothing continues because it's only you that's protected. Now, if you are married, if you've got people that you want this money to move along to, and chances are, I'm guessing that that's the case because that's the reason you're wanting to resign, right? You don't want GEPF to benefit from this money. So in this case, option one is not the most practical option for you, right? Because you're wanting to leave a legacy. So option two allows you to do that to a small extent because now you can have a spouse that's covered inside here. Same setup in terms of your increases. Your income can be adjusted again according to inflation. It can be adjusted according to a percentage. Again, when you set that up in the beginning, you don't have to be concerned in the future because it's structured in such a way that it's going to happen all the time, right? If you're choosing 5% increase, it's going to happen as a 5% increase all the time. Now, what you want to be very mindful of is each time you're adding a layer of protection, right? So notice in option one, it's only you that's covered. In option two, it's you and your spouse that's covered, which means two people. When two people are being covered, your initial income is going to be a bit lower, right? So you're starting off with a lower income. You still have your annual increases every year. Again, remember, income is not fluctuating, right? It's not like year one, month one, it's going to increase, month two, it's going to decrease. It's set according to what was agreed with you and the insurance company in the beginning with the annual increases taking place, right? The third section here, now this video again, just to remind you, is all about helping you to understand what would happen in terms of fluctuations, right? The concern around that. But I want to pre-frame this so that you understand the options and see why there's different options. So I just want you to be in a position to make the correct choice in terms of the income option. And then I want to give you peace of mind again in terms of the fluctuations. So third option that you have, you can take one or two, right? Meaning you can take the income for life option that I shared with you here, or the income for life, including your spouse. And now you can add a guarantee. Now, how the guarantee works, it's like this, right? Assume you're 60 and you can buy a guarantee up to 25 years. So that's to 85. So that's your 25-year guarantee. Now, let's assume at year X, you pass away, and year Y, your spouse passes away. Can you see from year Y to 85, there's a period in green. Now, that's the period that the income can continue, right? So if you have kids or if you have someone else that you want to benefit from this money, the insurance company has made a commitment to you that they'll pay for that term that you've chosen. Now, 25 years is the maximum. You can adjust that time frame, right, accordingly. I just again want you to have the foundational understanding of this so you know how to put it into practice. Notice again, you are buying a guarantee, which means your initial income will be a bit lower, right? Because you're adding another layer of protection. The second thing I want to remind you, again, like the first two options, the income is not going to fluctuate. So when you start off with an income, when the insurance company gives you an income, that income is going to increase according to what you had agreed upon. If you agreed on an inflation increase, it will increase like that. If you agreed on a 5% increase, it's going to increase like that. So no fluctuating of the income, right? Next option we want to look at is option 4. Now, option 4 says you're going to earn an income for life. It's the same as option 1, which means same as this option here, right? This time, in the event of you passing away, the entire lump sum that you invest gets paid over to your beneficiary. Now, I want to explain this thing very carefully, right? Let's use an example to say that it's you and your spouse. Now, you are using option 1, where you're earning an income for life here, right? In the event of you passing away, your spouse or the person that you want to get this income, they're not going to get the income, right? Because the income fell away when you passed. What do they get? They get the lump sum, which is the 4 million rand that you initially invested. So you earning an income for as long as you live, you can earn that to 80, to 100, whatever age that you pass away. At the time that you passed away, you can then elect for the entire capital that you invested to be paid as a lump sum to your beneficiary, right? Tax-free. Now, I want to go through the fine print of this one so that you understand it very carefully. What takes place here behind the scenes is the insurance company is going to take a life cover for you, right? and they're taking a life cover equal to the amount that you're investing. Now, in my example, notice the amount I'm saying you're investing is 4 million. So the insurance company is taking a life cover for 4 million. So you want to be mindful. Before you receive your income, you first are going to pay for that life cover. You also have to factor tax, right? What you are getting in your bank account is the after-tax amount and the after you pay for the insurance premium. Now, again, you want to be very, very cautious with this one. Sometimes with this particular option, the insurance company has a fixed income, meaning it is not going to increase every year. So you want to be, again, very careful with it, right? Because if it's structured in that way, your water is going to increase, the electricity is going to increase, the cost of living is going to go up, petrol is going up. So all your expenses are going up, but the income's remaining at a fixed level. So you want to be cautious with this one. Again, if there is the option for an increase, then you're starting off with a lower income, and you need to factor tax on all options actually. And you also want to factor in this particular option that you have to pay the life cover premium, right? So notice in the 4 options that I've shared with you now, in option 1, 2, 3, 4, in essence, you are giving your capital to the insurance company, right? In all these options, your income is not fluctuating. It's set for that period, right? Whatever you've determined, and the insurance company is going to honor the arrangement. They'll give you the increase according to what was described. Now, the 5th option is the one that is is where you take control, right? More control of this. If you think about this carefully, what would GEPF do with your capital? So if you had opted to retire, what are they going to do with the capital? And the insurance company, option 1, 2, 3, 4, what are they going to do with the capital? You know this already. They're definitely going to invest it, right? So let's start to look at this more carefully. And this is the 5th option. This is where you take more control, right? And you are going to be investing this capital. Now I'll explain it a bit more carefully on a new page so that you understand the concept better. Same structure. Here's your 2/3 capital in here. And this is the 4 million Rand that you have invested. Now, this time when you invest the capital, it's going to be invested in some place. The place that you invest provides you with a return. Now, pay careful attention, because this is where you might be feeling concerned that you could run out of money or the income's fluctuating, right? So you're earning a return from wherever it's invested. For now, don't be concerned about the markets and all of that. Just understand the concept of how this is working. The next thing is you have to take an income, right? You're going to take an income from it. Here's the difference now, is this income that you can take from it runs on a sliding scale, right? Which is from 2.5% up to 17.5% of the capital that you had invested. Now do the calculation with you, and you can also follow along, right? Again, we're talking in terms of the income fluctuations here. So I just want to reframe it so that you understand it. I'm first going to work out what 2.5% of that capital is. So, and then we'll go into the next step, which is calculating the 17.5%. So here's the 4 million Rand. I'm working 2.5% of that 4 million. This is the income for the year. So for the year, it's 100,000. If we divide it by 12, this means the income here is going to be 8,333. That's the minimum income. Now I'm working the 17.5%. So here's the 4 million Rand, 17.5%. This is the income for the year, right? Divided by 12, it's 58,333. So let's head over to the iPad now that you know how to calculate this. Again, you can watch the video again and see how I did the calculations and then use your figures, right? So that you have a better understanding. Or if you're needing some support and you are living in the next, within the next 3 years, you can always reach out to me and then I'll help you do the calculations on your own. So notice this income is, well, let's recap. What I'm saying is, if you have 4 million Rand capital or whatever your capital is, you can adjust it according to the scale. And let's say it is 4 million, you can take between 8,333 to 58,300. Any rand amount, right? You could take 10,000, you can take 20,000, 30,000. So you can adjust inside of this scale, provided it's not less than the 2.5% and not more than the 17.5%. Now, here's the difference. This is the only option that you can change your income yearly, right? Meaning you are in control here. So you get to choose the increase every single year. It's not like the option of GEPF, where GEPF would determine your annual increase if you retire. It's not like options 1, 2, 3, 4, where the insurance company presets that increase and you never get to change it again, right? With the fifth option, you get to change it on a yearly basis. You can adjust according to this scale. Now, you might be concerned if you are investing the money, it's inside the markets, is it going to fluctuate? So I'm going to clear that concern for you straight away right now. What I want you to bear in mind is whatever happens from a return perspective, whatever your investment is doing, right? It does not affect your income. See, it does not affect your income because the income is predetermined for a 12-month period, right? So let's draw that up for you. That income is going to be predetermined for 12 months. So whatever income you've chosen, I'm going to use an example again to make the math look easy here. Let's assume you chose an income of 30,000. It means for the 12-month period that you've chosen that income, that is the income that you're going to get, right? You have to factor tax. Every single option, even if you retire, you know the income is going to be taxed, right? So let's assume you chose 30,000. It is set over a 12-month period. You're always going to get 30,000, right? So whatever's coming into your bank account is going to be the same. So what happens in terms of the return? Well, the return itself can fluctuate, but your income is going to be consistent, meaning there might be a time that the return is very good. If the return is very good, you're not going to get any extra, right? Because the income is set for the 12 months. You're still getting your 30,000. If the return's not good, you're not getting any less, right? You're still going to get your 30,000 because that was the arrangement that was made with you and the insurance company, right? So again, whichever option that you are choosing, whether it's 1, 2, 3, 4, or 5, please be mindful. You don't want to make this mistake, right? You want to get this thing done right because most of these options, you can't change them later on. The only option that allows you to change later on is option 5, which I explained to you in detail here. This particular option, if you want it, allows you to change the income on a yearly basis. So if you need extra, you can take extra. If you need less, you can take less. In terms of fluctuations of the market itself, you don't have to be concerned because it does not matter what the market brings in. It matters what arrangement you've made, what income you've asked the insurance company to pay you. So they pay that set income on a regular basis. Now, with this option, you might be concerned that you could run out of capital if the market's not performing well. If you have that concern, you'll find other videos in the YouTube channel that's going to guide you on how to address that, how to invest for growth. Alternatively, I encourage you to reach out to me where I can set up the structure for you and help you to show you how you can position this to make it successful. And also how you can get yourself to, how you could get yourself to a point where the capital is going to grow on a consistent basis, even though you're taking an income, right? But it all depends on your set of circumstances. Now, these might not be all the options. These are the options that are available at the time of me shooting the video. So remember, if insurance companies bring out new products, you want to just analyze them. However, these products have been available for decades, right? It's what's been around for decades. So I wish you well on your journey. Comment below. I need to know from you. Having gone through this video now, is your mind at ease about the fluctuations, right? Can you see that you don't really have fluctuations taking place now? If you're choosing option 5, you get to adjust it. It's not fluctuations from the market, it's you being in control of it. Then I want you to also share with me if you're opting on resigning from the 5 options that I've shared with you here. Type in the comment below which of the 5 options is most appealing to you, right? If there's something else that you need in terms of support, comment below, share with me the question, and then if it's something that's worthwhile, I can benefit others, I'd love to do a YouTube video to help you out in your journey.